Hey guys, it's Josh here from the Health and Wealth Group. We're on to video number 4 of the Starting Your Investing Journey series. So today is a really important topic of asset allocation. So we've talked about getting started, getting your budget, setting up your new accounts, all good and well. Now comes the crux of what it makes to become a really good, long-term, successful investor. So really, asset allocation is simply just spreading your money or investments across different asset classes, different countries, different markets, and across different time. So really spreading your investments across many different areas to minimize risks if there's ever a downturn in the market. So the modern day successful investor that is going to be investing for the long term, we want to be looking at the benefits of passive investing versus active. So when you pay someone to be an investment manager or a fund manager, they're going to be more often than not actively managing their fund, which means they're going to be buying and selling shares within that all the time. So that means you're going to incur those costs, and that means you're going to get less return on your investments. Whereas passively, they're not buying and selling all the time, which over the long term means you're going to do a lot better. And the cool thing about it now, guys, is when you invest in the stock market, there's all these passively managed funds listed as exchange-traded funds. So it means you can access them with no minimum entry as long as you've got a direct investment account. If you don't, you can still directly invest with the mutual fund group. Generally, there's just a minimum of $5,000 entry into that fund. Now, you can still get into passively managed funds, but there's a big minimum entry. So what we really want to focus on is diversifying by owning low cost, which is the key, index funds. As I said, so index funds, they track a list of stocks, a group within a market, within a country, within a segment. So that's what an index does. So you don't have to pick and choose the shares. That's done for you by an analysis company. So it makes things easy. And that means you're not paying buying and selling fees, and hopefully you're going to minimize your tax incurrences as well. So when we're diversifying, I've just noted out a few things you want to look at. So index funds will track US stocks. So you can invest in the S&P 500. So you've got the top 500 companies in the US covered if you invest in the S&P 500. In Australian stocks, you could look at the S&P ASX 200. You've got the 200 top Australian companies covered. Then we've got international stocks. So you'll be looking at Europe, Japan, where they have their own indexes running. You can look at those international stocks. Emerging markets, this is where we'll be looking at China, India. So we're not putting all our eggs into any particular market or country. So if the US has a crash, like they've had, Japan might be fine, or things in India might still crank along just fine. So that's why it's important to invest across countries and time, and also then classes. So then we can look at real estate investment trusts. So you don't need to go and buy property. You can do that on the stock exchange with a real estate investment trust, or AREITs in Australia if you're going to invest in the Australian Stock Exchange. So they'll invest in commercial, industrial, mortgages, all kinds of stuff that's involved with the property market. So you can get into that simple and easy. And finally, to really look at diversifying and having a well-balanced portfolio, guys, you need to look at long-term treasury bonds and treasury inflation protected securities, or TIPS for short. So that means when inflation goes up, your face value of your bond also goes up, whereas normally when interest rates go up, bonds go down. So there's some really cool things out in the market, guys, and they're all really easy to get into because they're all now listed on the stock exchange, which means you, the retail investor, have access to be able to diversify and having a really good portfolio over the next couple of years that'll get you amazing returns over the long term with minimal risks, minimal costs. You're not paying any fees to a fund manager to do it for you, and you're going to get some really good tax benefits by holding it for long terms. So one I'd suggest to look at if you're looking at a company that is the best for low cost index funds, it's Vanguard. So that's where I would start looking. Really my pick of the bunch. So there you are, guys. The key to asset allocation, what to look for, what you can have access to, and how you can diversify across asset classes, countries, times, and markets. So there you are, guys. We're looking at passive, low-cost index funds. Hope that helps, and we'll speak soon. Bye.